Good morning, we are Team Poly and today we'll be presenting our investment thesis on Raia Drogasil.
But first, what is higher?
Drogasil is the largest drug retailer in Brazil, both in store number and in revenue terms. It has a strong footprint throughout the country, but its core remains São Paulo, which accounts for half its revenue.
Of Raia's four product groups, generics have the best margins, but most of the revenue comes from branded. The company is known for its outstanding execution, and since Raia and Drogasil merged in 2011, net income increased impressive 260%, and stock prices rallied over 100% in the last year.
So, is it time to invest in Raia?
No. Drogasil is a great company, but that is now unlikely to surprise the market. Therefore, we issue a hold recommendation with 190 reais target price for the end of 2020, resulting in an upside of 8.8%. The company seems to be priced to perfection, leaving investors with little margin of safety.
Our investment thesis is based on four main pillars: a promising industry, a prime competitive positioning, ability to expand and face competition, and finally, a demanding valuation, with both high growth and profitability already priced in.
Tell me, why is the sector so promising?
The industry is extremely resilient. Despite recent years' recession, it grew with a 12.8% CAGR, creating a significant spread to GDP. On the other hand, sector may also benefit from a positive macro perspective, as most of spending is out of pocket.
Beyond a positive macro scenario, Brazilian demographics drives growth on the road ahead. Age pyramid is set to invert, and elders will represent a quarter of the population by 2060. They consume medicine twice as often and spend 4 times as much as younger people.
And what is the takeaway? Aging drives industry growth, as we can see in the strong correlation between market size and percentage of elders. An R-squared of 0.99 enables us to extrapolate this model and estimate market size for the next 5 years, obtaining a 9% CAGR.
We also see the market fragmentation as an opportunity. We estimated an HHI of 229 and identified that top players hold 28% of the market, a level still much lower than those of countries like Mexico and Chile.
So, the industry will thrive and there is room for consolidation, but how is Raia positioned? Let's first take a step back to understand how a consumer chooses a pharmacy. We see that the primary decision factor is price, followed then by convenience.
In the pharmacy business, low product differentiation and weak customer loyalty drives companies to compete on pricing. In our field research, when analyzing a 20-item basket, we saw no company holding a clear edge.
Therefore, convenience is where the company stands out. We conducted a geospatial analysis to evaluate Raia's store positioning in São Paulo, its main city. We used QGIS software and census information. We plotted all stores from Droga Raia and Drogasil, as well as the PSP and Pague Menos, its main competitors. We concluded that Raia concentrates its stores in the most attractive neighborhoods, with the highest percentage of elders and average income. And as for the rest of Brazil, we see the same pattern repeated. Raia positions its stores in the richest locations.
And what does this mean for the company?
It has the highest sales per square meter and the second highest average ticket in the whole industry. But this prime positioning comes at a cost. These attractive neighborhoods are also highly competitive, and we see São Paulo as a consolidated market, and therefore not an expansion vector for Raia, which is concentrating stores openings and moving into new regions.
And what about e-commerce?
Raia is also well positioned in the segment, especially after it acquired Onofre from CVS Pharmacy. It has the highest share of online drug retail traffic and a well-developed omnichannel that benefits from store capillarity. However, e-commerce is still little representative, accounting for only 2.5% of revenue, with high regulatory barriers in the domestic market restraining its expansion.
It seems that Raia has a strong positioning, but what else makes it a top pick to serve the sector's tailwind?
First of all, Raia has unmatched organic expansion capabilities. It has opened nearly 900 stores in the last 4 years, all sustained by strong and consistent cash flow generation. The investment to open a single new store is not very high, but maturation curves delay break-even points, making it hard to cover for capex in the first years.
Other players even try to keep up with Raia's expansion pace, but as they faced margins and cash flow deterioration, they had to raise their leverage to expand. Eventually, their expansion momentum was lost, while Raia was able to keep its rhythm.
And what explains this difference?
Prime store locations, along with outstanding store-level efficiency, explains how Raia maintained good results while expanding. In a visit to a drugstore, an average Raia customer spends 70 reais, leaving to the store 11 in pre-tax profit per checkout. Pague Menos in the PSP not only have smaller average tickets, but also lower store margins.
Overall, High has a higher EBITDA per store and superior top to bottom line growth conversion, as evidenced through its OPEX leverage. In order to analyze store profitability and if organic growth pays off, we simulated the opening of a single new store. In our unit economics exercise, even under conservative assumptions for same-store sales, we arrive at both IRR and ROIC comfortably above cost of capital. We see that expanding is indeed the way to go.
Okay, it's proven that the Haya can grow organically now, but what else makes the company leave competition behind?
Well, the competitive landscape is challenging and a new threat has emerged. Small and medium independent players started gathering associations, seeking to improve store execution and bargaining power with suppliers. As a result, they offered lower generic prices and a higher loss share in the segment. It was forced to strike back to aggressive discounts to recover participation.
But is this strategy sustainable?
We ran a generics price war simulation to evaluate the effects of more aggressive generics pricing policies. We analyzed gross margin impacts from stronger generics discounts for higher, associated chains, and independent players, taking into consideration generics' different penetration in their product mixes.
The result was clear. Haya Drogasil's margins are less harmed by stronger generic discounts, allowing the company to withstand longer and win this battle.
And what about the returns?
ROIC does not set Haya apart from competition, though. We see that all players have tight NOPAT margins due to a low customer advantage, with D&A expenses particularly weighing Haya down. Although invested capital turnover seems to be in line, all of Haya's possible edge is taken away by its low fixed asset turnover. We see that Haya's conversion of capex per store opening into new revenue is actually lower than those of its competitors for new stores.
But wait a minute. Until now, we presented a company that is well positioned in a sector with great perspectives. Why then the hold recommendation?
Overall, we do not see in the near future any major price catalyst able to justify incurring risk of buying the stock, which we believe it's already close to its fair value.
Let's now take a closer look into our premises. We projected a recovery in mature same-store sales, reaching 5.1 in 2022. Store openings will keep going strong, slowing down only 2021 onwards. We expect more than 1.2 thousand new stores in the coming years, and projected under a 4-year maturation curve. As a result, net revenue will maintain a CAGR of 15%, which is in line with consensus estimates.
Gross margins should suffer short-term pressure from generic discounts, but the private label penetration and a slight growth of generics in the mix should boost it in the long term. Fixed expense represent most of SG&A for a single store, so the maturation of stores and same-store sales levels above inflation should drive significant gains in EBITDA margin, which consensus sees as well. Expense were forecast linked by micro indicators as well as the opening of new stores.
In balance sheet projections, we highlight a gradual reduction in DIO levels, improving cash conversion cycle. Working capital is set to follow store expansion curve, growing initially with a 14.5% CAGR and then decelerating alongside expansion.
Capex will follow the same trend. Furthermore, store maturation will boost cash flow generation, allowing Haya to finance its own expansion, as CFO surpasses CFI.
So you're telling me all these projections have already been reflected in the current price? Is that so?
Yes, in our DCF, we projected the FCFF for the next 10 years. We used a 0.72 beta to arrive at a 10.8% WACC. In perpetuity, our assumptions were a 6% growth rate and no tax benefits.
Even under bullish assumptions, our upside was only modest. Our DCF arrived at a target price of 109.8 reais and 8.8% upside. Our recommendation was consistent through our WACC and perpetuity growth sensitivity analysis.
On a multiple analysis, Haya seems rather expensive. PE is at historical maximum, trading over 2 standard deviations above average.
1 minute remaining.
Not even aggressive growth estimates justifies the stock price premium, as can be seen through the PEG ratio.
But what if our projections are wrong?
Our bull and bear case scenarios target price range from a 19% downside to a 30% upside.
We ran 10,000 different scenarios in our Monte Carlo simulation, arriving again at hold recommendations for 62% of the times.
The greatest risk to our model comes from major same-store sales fluctuation. In fact, our tornado analysis showed that same-store sales is indeed the most volatile premise to our model.
We thank you very much, and now we're open to questions.
Thank you.
Okay, since the digital sales are only up to 2.5% of sales, And since we are facing mobility restrictions, and I don't know if they sell other products besides medicine, how does this crisis of mobility could affect your estimates for this year and for the upcoming year?
Okay.
Okay.
Yes, sure. So about the e-commerce, during the current crisis, yes, we have a lockdown, so people tend to buy more online, and maybe this will create a tendency for the future. So as you said, there are some regulatory barriers in Brazil for the advance of e-commerce in the pharmacy business. The HPC products, which are the products sold in the front store of a pharmacy, they can be sold online. And we think for these products, it can be an increase in demand. But these products aren't the majority of the products the company sells. So for the prescription medicine, which accounts for most of the company's revenue, there are several regulation barriers in Brazil for these advancements. For instance, for buy prescription medicine, a person is required to be at the pharmacy counter with the recipe in hand. So there's not much companies can do to avoid this. But regarding the HPC products, we see that it can be an increase in penetration for the third years, but we don't see many potential upside in this increase for the next years.
In the United States, most of the drugstores are very successful here, have broad product pipelines, simply because it's one-stop shopping, especially for older folks. What does your company have that similar approach to it? They're selling a lot of other things other than just scripts?
No, in Brazil, drugstores are quite different than the United States. For instance, if you take a drugstore in the United States, they are about 800 square meters. They sell from a wide variety of products. In Brazil, drugstores are quite small. There are 100 meters squared, and they sell mostly health products like soap, cosmetics, and drugs. We see a very different approach in Brazil. And it's also important to notice that in the United States, although the pharmacy business have different product mixes, we see like CVS and Walgreens struggling with their front store business recently, mainly because people in the United States, people are tending to buy this kind of products more in other kinds of stores. You see Walmart increase this type of sales. We see Amazon sell a lot more of these products. So in the United States, these companies are returning back to sell more health products than this other type of groceries.
Yeah, and it's important to notice that in Brazil, regulation is really strict. So just recently, that pharmacies were allowed to sell products like food and beverage, but it's something very recent. And the pharmacies, they don't have this same thing as my team member said, João, this thing about being one-stop shop that sells a lot of things. So they do have like some little products that HPC and some beverage, but in Brazil, mainly people go to a pharmacy to buy medicine, to buy OTC products.
What is the single factor that will turn your recommendation into a sell? Especially there is a new competitor that has come into the market, and this competitor is competing on the company's high margin segment of generic drugs.
So I think the main thing that would change our recommendation towards a sell will be the company's expansion. This company trades at a very, very high multiples because the market expects the company to sustain a very high level of growth during the next years. So the company is currently expanding to new regions, and we think that the main factor that would affect our recommendation towards a sell, it will be if this expansion didn't go as the company expects, because a very high growth rate is expected from the company. So should the company fail in maintaining this aggressive opening of new stores, I think this might impact our recommendation.
And we see it's important to highlight that expansion may fail in two aspects. We see that it has prime store locations and the best returns for a single store on the market. And should it fail to find these new points of sale with the same returns and still open stores, it could lose its returns, or it could not open those new points of sale and then not expand. So it may fail in two ways.
Yeah. Expansion may slow down and lose quality. both
That's
ways
true.
in which we could have a downside scenario.
Which would harm cash flow generation. That's correct.
Could you elaborate on regulatory risk?
Yes.
Yes.
Sure. So I think there's two main regulatory risks we can talk about. One of them is the Brazilian price cap. So the readjustment in medicine prices in Brazil is regulated. So there's a limit. If Leo wants to comment a little on that.
Yeah, about CMED is a regulation chamber in Brazil. So you can readjust price about these medicines, both for industry, pharmaceutical industry, and pharmaceutical retailers, because you have a limit. So this limit in many years is even under the inflation levels. So the graph that we are showing right here show exactly that this price cap is below inflation, and this harms a lot the returns and the profitability for both industry and pharmaceutical retailers. And another regulatory aspect that is very important, as João said before, is about e-commerce. For example, Hydrogazil, 44% of its revenue comes from branded medicine, prescription medicines that you can commercialize, you can use that in e-commerce. So if we don't believe this will happen, but if this regulatory loosen up a little bit, we think that e-commerce could be a huge driver, potential value driver for the company.
But just to complement the question about this price cap, there's an important hedge companies do with their inventory. So when the government is close to announce the new price cap, companies tend to buy stock more products to sell them with a higher margin after the government readjustment.
It's a way to adapt these market specifics.
And are there any threats to its brand product margin base, because they have the biggest margin, and I don't know if there can be a threats coming from generics or competitors.
Okay, so actually generics have the biggest largest margins in the sector. So penetration in generics, increasing the generic penetration in Hydrogazil's margins is actually positive for the company. And about competitors, as we said it before, there was a thread that started increasing their discounts to generics that made Hydrogazil's movement in their stores decrease. But why we believe that Hydrogazil is able to win this battle and to don't be harmed by this competition. We ran a generic price war simulation that we had the penetration, generic penetration and branded penetration for Hydrogazil, independent players, and associated chains. And of course, we had to do some assumptions, but we know that every discount for non-reference medicine like these generics is 60%. And we also know that the margins for generics are, the average market gross margin for generics is 55%. And for these branded medicines, the average market gross margin is around 20%. So we can see here in our price war simulation that, for example, if Hydrogazil's increase its generic discounts in 5%, it would be less affected than these independent players, for example, 3 times less affected by these independent players. So about the competitors, okay, you can comment.
And just to finish about other competitors rather than generics, we see these Raya's main competitors. They recently tried to increase their opening of stores to match Raya's organic expansion, and they couldn't find this same premium spots that Raya keeps, and they didn't have the same store execution. So they had to they harmed their cash flow generation, and they had to raise a lot of the leverage to expand. And currently they have negative net openings. Meanwhile, Raia is still keeping a very high store openings ratio.
For example, Pague Menos, that is the 3rd largest retailer in Brazil, that started opening a lot of stores in São Paulo, Raia's main core, had to close a lot of these stores because it couldn't face Raia's competition. And for example, exposing same-store sales, a negative major same-store sales that is around a negative 4.4%. Just to show that.
All right, that is time. Thank you, Universidade
thank you.
Sao Paulo, with a hold on Raya.